Okay, this is part 3 of Unit 4C. We were just finished in the last video talking about stocks. One other thing to mention here that we will use is how much earnings there are per share. And the way we calculate that is we take the share price and divide it by this price to earnings ratio that will be given to us. So here it is up here in our example. That's just a formula that I would write down when you're trying to find the earnings per share. It's the share price divided by the price to earnings ratio. Okay, so we're going to analyze this stock number 40. So we are looking at Walmart. So as we look at Walmart here, we're going to be answering all the questions on the right hand side. So first, part A, what is the symbol for the Walmart stock? Okay, that is just WMT. Our symbol will be found right here, right next to the name of the company. Okay, next, what was the price per share at the end of the day yesterday? And so, again, remember when we're looking at this, we've got the last. So again, last is kind of another way of saying now in this picture up here, what the value is worth now. And so to find what the price of the share at the end of the day yesterday was, is we're going to take the last, and then we're going to subtract from that the change, how much it's changed over the day. So here's last, here's change. So 78.81 minus $1.28, and we get $77.53. So that was the price per share at the end of the day yesterday. And that's how we'll come up with that. Okay, part C. Based on the current price, so again, current price last, what is the total value of shares that have been traded so far today? So the way we're going to do that is we're going to look at, what's the current price. Again, up there in that, it's the last of 78.88. And we're going to times it by how many shares were traded today, which is the volume of shares. Okay, and the volume is right there. So 10.65 million shares have been traded. So you're going to do 78.81 times it by 10,650,000. And this is going to come out to be a pretty big number here. So it's 839,726,500. Yeah, so about almost 140 million on that one is the total value of shares that have been traded so far today during the day, whatever point in time we are in the day today. Okay, D, what is the price of all Walmart shares that have been traded so far today? Okay, when we're looking at that price, what percentage of all Walmart shares have been traded so far today? So the way we would do that is we're going to look at the volume, how much has been traded today, and divide it by the shares outstanding. So we're going to be looking again. Here's our volume. Here are the number of shares outstanding. So what percentage has been traded? So it's going to be some big numbers here. So 10,650,000. And you're divided by 331 million. So you 3,031, and then million is times 10 to the 6. So you're going to add 6 zeros on the end of that. And when I do that out, I get 0.0035, which is 0.35% of the stocks have been traded on whatever given day we're looking at here. Okay, next, part E. Suppose you own 100 shares of Walmart stock. So based on the current price and the dividend yield, so again, current price is last over here, and here's our dividend yield. What total dividend should you expect to receive this year? Okay, and dividends are just the money that you were paid out on your stocks. And so what we're going to do is we're going to take the last, or the current value, times it by 100 because you own 100 shares, and then we're going to times that by, make sure I spell it right, the dividend yield as a decimal. Remember, whenever you're multiplying these things out, you're going to times them by decimal. So we're going to get 78.81 times by 100 because you own 100 shares, times that dividend yield, which is 0.0263. So you would expect to be paid out, and of course I didn't calculate this number, so let me get it out for us here real fast. $207.27 is what you would expect to receive this year in dividends if you own 100 shares. Okay, now we're going to look at Part F. So what were the earnings per share for Walmart? Now remember, earnings per share, that was the share price divided by the price to earnings ratio. So we're going to take a look here, and so our current price, 78.81, and divide it by that price to earnings ratio, which is 17.85, and that's about $4.42. So that's the earnings per share for Walmart at this current time. And so our last one is how much total profit did Walmart earn in the past year. So this is Part G. So it was $4.42 per share, and then we need to times that by the number of shares outstanding, which is 3,031 million. So this can be a massive, massive number. It'll turn out to be about $13.4 billion. And that'll give us how much total profit Walmart earned in the past year. So that's just looking at some general calculations on stocks. And not everything, you do not need to have everything memorized. If you're asked to do calculations with stock, this table, this information will all be given to you. But we've just done some basic calculations in analyzing stocks. Okay, the next thing we're going to look at is a little bit more information on this price to earning ratio for each stock. Okay, so we wanted to first look at how much were earnings per share. So first we're going to look at Costco. And remember that our earnings per share, we're going to take the price per share, and we're going to divide it by that price to earnings ratio, which is 20.84. Okay, and this is about, they made about $8.23 per share for Costco. And then the next question is, does the stock seem overpriced, underpriced, or priced about right, given that historically the price to earning ratio ranged from 12 to 14? Well, so what we're going to do is, if it normally ranges from 12 to 14, and Costco has right now currently a price to earnings ratio of $20.84, then what we're going to say is that this stock right here for Costco is slightly overpriced because our price to earnings ratio is currently higher than what it has been historically. So we would just say, based off of that, it's slightly overpriced. And again, that's because the current price to earnings earnings ratio is greater than, and it said our we're looking at the range of 12 to 14. So it's greater than the bigger number there. And so it means we're just slightly overpriced on this one. Not too bad, but we are a little overpriced. And that's what people look at sometimes when they're buying and selling stocks. Okay, next we're looking at IBM. So IBM closed at $151.98 per share with a price to earnings ratio of 12.49. So the earnings per share for IBM over that past year would be, let's see, punch this in here, $12.16. So that's how much they earned per share. And then when we compare the price to earnings ratio, we have 12.49 is what it is right now. And that falls in the range, so it is between 12 and 14. So it's bigger than 12, but it's less than 14. So this means that this is priced just about right based off of the historical data that we have for IBM. Okay, so that's how we'll use price to earning ratios and what they were historically to see if we are, if that 12.16 per share for IBM, 8.23 per share earnings for Costco, where we're at on those compared to a historical standpoint. Okay, so next we're going to talk a little bit about bonds. We're going to run out of time, but again, this is a 2-day lesson, so there's a lot to cover in this. Next we're going to look at is bonds. So bonds, most of these have 3 main characteristics. One is the face value of the bond, and that's the price you must pay the issuer or to buy it at the time at which it is issued. So that's what we call the face value. The coupon rate of the bond is the simple interest rate that the issuer promises to pay. So for example, if the coupon rate is 8% on a bond with a face value of $1,000, that means the issuer will pay you interest of 8% times $1,000 or $80 a year is what they're going to be paying you back in interest. Then you have what's called the maturity date of the bond, and that is the date in which the issuer promises to repay the face value of the bond. Okay. However, now, if that were the end of the story here, bonds would be pretty simple. However, bonds can also be bought and sold after they're issued. So then this kind of adds in a secondary bond market that makes things a little bit more complex. So for example, suppose you own a bond that has a $1,000 face value and a coupon rate of 8%. Further, let's suppose that new bonds with the same level of risk and the same time of maturity are issued with a coupon rate of 9%. So now they're offering a little bit more. In that case, no one would want to pay $1,000 for your bond because the new bond offers a higher rate. And so it kind of devalues your bond. However, you may be able to sell your bond at a discount or less than its face value if you're running something like that. However, in contrast, though, suppose that a new bond is issued at 7%. Kind of with the same parameters. In this case, buyers are going to want to buy your bond because it's going to get an 8% return, and therefore they may pay a premium for your bond, which is a price that is greater than its face value. So, kind of more generally, we're going to be looking at what's called the current yield of a bond. And that is defined as the amount of interest it pays each year divided by the bond's current price, not its face value. Okay, so here's current yield is the annual interest payment divided by the current price of the bond. I'm just checking my time here. So I'm right up against the clock. So we're going to look at bond yields in number 49 here in the next video.